Hey everyone, I want to start this week by wishing everybody a happy Thanksgiving. And as everyone knows, the day after Thanksgiving is Black Friday, the unofficial kickoff to the holiday retail season. This week, I'll focus on the holiday sales outlook, which according to the National Retail Federation and ICSC is expected to be the strongest on record. But before I go there, I want to touch on a couple of things that happened last week. First, the headline inflation reading came out at just 3.2%, down 50 basis points from the month prior. Likewise, core CPI fell 10 basis points to 4.0%, its lowest reading since September 2021. Of course, we're still a ways from the Federal Reserve's target of 2% inflation, but we are moving the right direction. And according to Wall Street, the odds of the Fed holding rates flat at their December meeting is now 99.9%. That carries over into January with a 98.9% likelihood rates will still be flat. And looking beyond that, the May 2024 Wall Street prediction fragments a bit with a 42% likelihood of remaining flat and a 47% chance of a 25 basis point reduction and an 11% likelihood of a 50 basis point cut. Personally, I think Wall Street may be a bit over-optimistic about the chances of a rate cut. Unless there's a looming recession, I personally don't think the Fed will cut rates that soon. But nonetheless, it appears the Fed is likely done raising rates, and that alone is a good sign for the commercial real estate market. The second major event of last week was Congress's extension of the deadline for setting a new budget to January 19th and February 2nd of 2024. As a result, the budget fight has only been postponed again, and in the middle of January, we'll go through this process again. But at least we all get to go through the holiday season without a government shutdown hanging over our heads. Now, back to my core topic of retail sales. In general, retail sales have sustained positive momentum. They now stand at a record high with year-over-year growth of 0.2% on an inflation-adjusted basis. And ICSC is forecasting 3.8% year-over-year growth for the holiday season, which is in alignment with the National Retail Federation's forecast of 3 to 4% gains. Those growth rates are on an absolute basis, they're not inflation adjusted. But even on an inflation adjusted basis, the National Retail Federation's forecast of about $960 billion of holiday retail sales would be a new record, up by about 0.5% versus last year. These gains will be supported by a variety of positive factors. First, 2.9 million more people are employed this year compared to last, a gain of 1.9%. Second, inflation-adjusted disposable income is up by 3.5% from last year. Third, although total inflation-adjusted savings is down by 1.6% compared to last year, savings are still elevated and about 3.6 trillion inflation-adjusted dollars above pre-pandemic levels. All three of these economic drivers will support the holiday sales climate, benefiting both brick-and-mortar locations as well as e-commerce sales, which constitute about 21% of the total. And while the holiday retail season can make or break the year for a retailer, from a commercial real estate perspective, it tends to only modestly influence space demand. That said, the retail sector remains strong. Absorption has been positive for 12 quarters in a row, filling 188 million square feet in that time. In the third quarter, the absorption of 10 million square feet modestly outpaced completions, keeping the vacancy rate stable at 4.6%. Industrial commercial real estate has also been strong, with the third quarter marking the 54th consecutive quarter of positive space demand. But unlike retail, builders continue to deliver industrial property at a record pace. This year, approximately 400 million square feet will come online, which is pushing the vacancy rate higher. As of the third quarter, industrial vacancy was 4.8%. So as I mentioned earlier, the holiday retail season looks like it should shape up to be modestly positive, a good sign that reiterates the prospects of a soft landing. As we look beyond the holidays, the outlook is still very difficult to discern. There are a lot of variables in play, but the momentum has generally been positive, and most of the forecasts for 2024 still call for slow but steady growth. That said, we'll need to keep our eyes open and watch for any significant disruptive events. As always, we need to remain vigilant, and we need to keep our eyes on the horizon.